Today we are looking at 4 dividend stocks that every investor must own. We're going to run through each one, understand why we believe it is very pivotal to have within your portfolio. We're also going to run through their metrics. We will cover their dividend safety, but importantly highlight some of the metrics that you need to look for other dividend stocks within your own portfolio. And as always, we will run through each one of these in the valuation model so you can understand, whilst it is imperative to have these in your portfolio in some shape or form, but also whether right now we believe their intrinsic value is showing signs of undervaluation by getting to our acceptable buy price and finding out what Wall Street expect over the next 12 months. On top of this, today we are going to take a look at 2 alternatives, so some very strong ETFs, essentially the S&P 500 trackers. We're not just going to look at VO today, but also I know a lot of people watching these videos don't have access to this ETF. For those who are European or non-US, we are going to take a look at an alternative, which is VUSA. Now, this in fact is one that I do also hold within my own portfolio, and we'll discuss a little bit of that later on in the episode. So let's start off with the first one that you must have as a position or a core position in your dividend portfolio. It is Broadcom, ticker symbol AVGO. Now, over the last year, this is up 112%. It is a very strong performer. And looking over the last 10 years, up over 2,000%. Absolutely phenomenal. And when you bear in mind, it does not include those dividends reinvested. That is a very strong performer. Now, we can see it trading at the upper end of the 52-week range. Given the real hype around AI, it has really helped Broadcom increase their total return. And we can see the yield is sitting around 1.58%, with a forward P sitting at just over 28. Now, dividend safety score, we have a score here of 67. It does look to be safe, with a market cap of 614 billion, a mega cap company. Now, in terms of the key metrics, well, last recession they paid no dividend. However, they did have a negative 12% sales, which was essentially the average of the S&P during that period. First reason, love the dividend growth. Double digits last December, double digits over the last 5 years, double digits and very high 36% over the last 10 years, effectively meaning that every single year over the last 10 years, on average, the dividend has increased by 36%. On top of that, they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, now this is for those that are new to the channel. Essentially, it shows a company is undervalued when the current yield sits above the 5-year average. So for Broadcom, this is a signal of overvaluation, the same signal on the forward PE as it sits 26.4 above the 15.1 average. But do bear in mind, we don't look at any of these in isolation, and we'll conclude towards the end. We can also see it is pretty much in line with the information technology sector PE at 26.6. Now, in terms of the payout ratio, as always, focus on the free cash flow, my own personal preference. A lot of investors do prefer the earnings. I do believe it is susceptible to manipulation by management through accounting, and we have many examples where we do run through this. My preference, below 60%. If you want to be industry specific, semiconductors below 50%, and we can see over the last 10 years it has been below that. 45% in 2023, looking very healthy in 2024 at 35%. Now, one thing we do want to point out when we are looking at these 4 must-own dividend stocks, try to understand the themes that you do see and compare it to stocks in your own portfolio to understand whether or not they are very high quality and could be considered must-own stocks. Free cash flow per share, one of the best, take it from me. We have reviewed a number of shares on this channel, or stocks in fact. In terms of the free cash flow per share, very consistent over the last 10 years. 2024 expected $60.50. So this is very phenomenal in terms of their free cash flow per share growth, and probably one of the best in terms of those stocks we are reviewing today. Sales growth, whilst we typically like to see 3 to 7% for steady moderate growth, Broadcom do much better than that over the last 10 years. Although we do note the last year, one of the slowest at 8%, nonetheless is still very strong. And numerically, we can see a rapid growth on their top line from 4.3 billion to 36 in 2023. Now, one thing we like to see from companies is when they do a lot of share buybacks, essentially increasing your ownership within the company. With Broadcom, unfortunately, we've seen the opposite. They have diluted your position over the longer term by increasing those shares outstanding. But you probably, as an investor, if you had held from 2014, wouldn't really be massively bothered given the fact that the share price has increased substantially, as we noted, over 2,000%. ROIC, we want to see above 10%, again, industry specific, above 12%. Very inconsistent on this metric, although we do note the last 3 years looking very healthy, and 26% in 2023, their best performing year in terms of the ROIC. Operating margin assigned here on both operating and free cash flow of efficiencies. The operating margin has increased over the longer term, very strong at 46% in 2023. The same can be said for the free cash flow margin, with the last 4 years looking very, very consistently strong at 50%. Very, very attractive for potential investors as well as those current shareholders. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. We want to see below 1.5 for semiconductors, and again, these are essentially the number of years it takes the company to pay off their debt net of cash on hand. Bear in mind, this does correlate to both dividend safety as well as balance sheet strength. 1.1 looking very healthy in 2023. Now, it is expected to go up just below 2 in 2024, hence why you see maybe not the highest dividend safety score, but it does look to be safe nonetheless. So a lot of metrics that you can hopefully take to your own portfolio to understand why we do believe this to be one of those must-own dividend stocks with some phenomenal dividend growth year on year. As always, if you are enjoying the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models to get to our intrinsic value. Today's episode, let's just get straight into it. And for Broadcom today, we've only used the discounted cash flow valuation, giving us a value of $1,670. Now, with the current price at $1,324, we are going to start off with a margin of safety of 10%. Remember, 10%, wide moat, strong financial metrics, and good forward-looking data. Those are the three criteria for us to allocate on the 10%. If we believe that it is a buy up to $1,500, at 15%, a buy up to $1,419. At 20%, we can see pretty much around the current trading price. So even though this company has been on a phenomenal run over just the last year, and in fact over the last 10 years, we do believe right now there is a healthy MOS level of 20%. In terms of Wall Street and their forecast, well, they see upside of 19%. Again, they also believe some very strong upside. They consider Avgo to be a very strong buy with a price target of $1,577. As always, do let us know your thoughts as we do run through these stocks on today's episode. The next must-own dividend stock is none other than Microsoft Corporation, ticker symbol MSFT. Up phenomenally 53% over the last year, and over the last 10 years, not as strong as Broadcom, but still nearly at that 1,000% mark. Bear in mind, not including dividends reinvested. It is trading towards the upper end of the 52-week range with a yield of 0.71% and a forward PE sitting around 36. Dividend safety score 99, very safe, the highest score obtainable, and a market cap 3.13 trillion, a mega cap company. Dividend metrics from the last recession, well, they in fact maintained it, as we can see here. In terms of sales, will average around negative 9%, and they had a near S&P return at negative 48%. Dividend growth pretty consistent over the last year as well as the last 5 years at the 10% mark. Over the last 20, however, looking a lot stronger at 19%. Nonetheless, well above the minimums 4% we advocate on the channel, and they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, we can see here another sign of overvaluation purely on the yield, and looking at that forward P as it sits above 30.4, and we can note it is above the information technology at 26.6. Now, looking at the free cash flow payout, no real worries. It has been decreasing over the longer term, and 2024 expected to go down to 31%. So it would be a massive surprise if for Microsoft this year we don't see a dividend increase in the double digits. Very impressive as well, their free cash flow per share, as we can see, more than doubled to $7.99 in 2023, expected to be near around $10 in 2024, so lots of phenomenal growth over the period with MSFT. Sales growth above the 3 to 7% nearly every year. In fact, from 21 to 22, the best years of the company, up 18%. Still 2023, still at the upper end of that baseline that we look for. Sales billions numerically then, 87 billion, as we can see, more than doubled to 212, and it continues to increase year on year. They also do what Broadcom unfortunately didn't do, which is share buybacks. As we can see, they have bought back nearly 1 billion worth of shares over the last 10 years. In terms of ROIC, very strong, very consistent, which is very nice to know as investors. 34% in 22, 31 in 2023. So this is the type of metrics you want to see in high quality companies, not just very strong ROICs, but operational efficiency on the margins. As we can see for Microsoft, 42% over the last 3 years. Free cash flow margin as well, pretty consistent, 28 in the last year, looking very healthy as well. Finally, net debt to EBITDA. In fact, in 2023 and the last 10 years, it wouldn't even take them one day to pay off all of their debt net of cash on hand. They have one of the best balance sheets in terms of companies with a AA rating. Only Johnson & Johnson has the equivalent. And we can see here 2024, although it is expected to increase 0.222, still no worries there for shareholders. So taking a look at the valuation, this is a very strong company, and what we can see here for today's episode, the intrinsic value comes to $433. We can see with the current price at $421, there is very minimal MOS level. Even at 5%, you would have to wait at $411. But as always, different investors will purchase stocks at different MOS levels depending on their investment thesis, and some do typically trade at a premium, so even at a 0% margin of safety, we can see it is a buy. In terms of Wall Street and their forecast, well, they actually believe some nice double-digit upside, 11% with a price forecast of $469 over the next 12 months. The next must-own dividend stock that we have is the Home Depot, now up 37% over the last year. Over the last 10 years, up 387%. We see it trading at the upper end of the 52-week range with a yield of 2.35% and a forward PE sitting just below 25. Dividend safety, well, very safe score of 87. Market cap 380 billion, a mega cap company. Now, the last recession, they in fact maintained the dividend. They didn't cut it, but they didn't also increase it. They had average growth at negative 11%, and they also significantly beat the S&P, negative 44 versus negative 55. Now, the dividend increase wasn't too bad last month at 7.7%, but we were hoping for double digits as we have seen over the last 5 and the last 20 years. So do note, with these very high must-own dividend stock companies, they do have some very nice dividend growth rates. And we can see Home Depot has been increasing the dividend for the last 15 years and paying a dividend for the last 36 without a reduction. Now, in terms of dividend yield theory, we have a sign here of reasonable valuation with the yield near enough the 5-year average, but we do note the forward PE sits slightly higher than the 5-year average of 21.4 and significantly higher than the consumer discretionary sector PE at 15.1. Now, in terms of the payout ratio, as we can see here, only 1 year has it been above that 60% maximum that I don't really want to see. Since then, it has come down in FY24, and even though FY25 it is expected to come up, 55% isn't the worst, and still below that minimum or maximum, in fact, 60% target. Free cash flow per share also increasing more than 3 times over the last 10 years. Yes, it isn't essentially consistent, but do understand the type of business that it is, and we can see 2025 expected a decrease to $16.20. In terms of the sales growth, well, pretty strong consistently over the last 10 years, around that steady moderate 3 to 7, but we do know FY24 was their worst performing year over the last 10 years with a negative 3% to their top line. Numerically, though, they have essentially increased it by nearly double over the last 10 years. And what is very nice about Home Depot is they do a lot of share buybacks, as we can see here, reducing from 1.35 billion down to 1 billion in that latest period. Now, in terms of the ROIC, not really more that you could ask for, consistently well above the 10% minimums and at very high numbers, even 39%, which was one of their lowest years of the last 10 years, looking very strong and incredibly attractive to investors. Operating margin, whilst it does straddle around the 13 to 14% mark, as we can see, it is there very consistently year on year, so absolutely no worries there. And the same could be said for the free cash flow margin, looking very healthy with no red flag or potential red flag indicators. The same could be said for the net debt to EBITDA as well, significantly below the maximum 3, and in fact over the last 10 years it has been below 2. FY24 and 25 expected around the 1.84 level, so no worries, a strong balance sheet, and that dividend does remain to be safe. Now, in terms of the valuation for the Home Depot, don't forget you can grab a copy of this model in the pinned comments below if you want to get to the intrinsic value or the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. So margin of safety at 10%, we can see it isn't quite there yet for Home Depot. At 5% it is. Again, different investors will look at different MOS levels, and in fact some people, which in my opinion isn't the worst strategy, is when they do find high quality companies, is just invest every few weeks, every few days, and just dollar cost average in, which does seem to be a very strong strategy that we can review later on the channel. Now in terms of Wall Street, while they see 7% upside, they do believe the forecasted price over the next 12 months won't be too dissimilar from our intrinsic value at $408. Now, the next dividend stock that we do believe needs to be in your portfolio, today we have selected MasterCard. However, the business is extremely similar to Visa, so you could swap this out for Visa Incorporated. Now, MasterCard, ticker symbol MA, is up 36% over the last year. Over the last 10 years, very strong, up 567%. Now, the reason why we've gone for MasterCard today is purely down to the fact that we have recently reviewed Visa on the channel, so we didn't want to be too repetitive. We can see the price is pretty much at their 52-week high, with a yield of 0.55% and a forward P sitting at 33.46. Another dividend safety score, very safe, 99, market cap 449 billion. It is a mega cap company. Now, last recession, again, they maintained the dividend. Whilst they didn't increase it, they also didn't cut it, as we can see. They had plus 2.1% sales and a very strong recession return in comparison to the S&P at the negative 12% level. Again, similar theme across all of these high-quality companies, pretty much double digits across every single year. And on average, if you've held MasterCard over the last 10 years, that dividend would have increased 23% year on year, and they have been increasing those dividends for the last 12 years consecutively. Now, in terms of dividend yield theory, we do know a sign here of reasonable valuation. If you look, both yields and forward P are pretty much bang on their 5-year average, so this does give a signal of that reasonable valuation, and we do know the financial sector P does sit significantly lower. Now, in terms of the free cash flow payout, no worries whatsoever. Again, another theme to pull out from these high quality stocks, their free cash flow payouts do tend to be significantly lower. In fact, around the 20% level over the last 10 years and expected in 2024. Again, free cash flow per share increasing very strongly, as we can see here, more than 4 times growth over the last 10 years, expected to go higher in 2024, so there is a lot of nice growth to be seen. In terms of sales growth, nearly in fact double digits every single year. We have that justifiable COVID year in 2020, 13% in 2023, looking very healthy. In terms of total sales, well, very, very nice to note, nearly 3 times their top line. This is a company that has a lot of strong metrics, as I'm sure you're aware. And another one is here with those shares outstanding, as we can see, increasing your ownership of this company over the last 10 years by doing those share buybacks. We then get to the ROIC, phenomenal. We're looking at some very, very strong numbers. The fact that the lowest is 41% in 2020 is very strong to see. Now, we are looking at high quality companies here, so don't think that these metrics are something that we see in all of the companies. There are a ton of companies that do struggle in most of these metrics. In terms of the free cash flow and operating margin, very strong. We're talking about 55% nearly every single year over the last 10 years on the operating side, and in the mid-40s in the free cash flow. We are talking about one of the best companies and one of the strongest metrics that we have seen on this channel. Net debt to EBITDA, we can see in fact below 1 every single year, 0.47 in 2023, 0.42 expected in 2024. So there aren't any red flag indicators in any of these companies that we have reviewed. And we just want to point out that if we were to review the Visa today, the metrics would have been incredibly similar. So when we take a look at the valuation for MasterCard on today's episode, this is essentially the average of those two models, coming to $528. Now, margin of safety at 10%, we can see it isn't quite there yet, but it isn't too far off. So we do see a 5 to 10% MOS level for MasterCard in today's episode. Now, in terms of Wall Street, well, they believe upside of 7%. They have a price target of $515. So as I said earlier, it isn't too bad if you do identify a lot of high quality stocks and do just dollar cost average in over the longer term, if you do have an investing time horizon of over 5 to 10 years. Now, as we mentioned at the beginning of the episode, there are alternatives. For example, if you do not want to invest into individual stocks, as we mentioned, we just ran through Broadcom, Microsoft, Home Depot, and MasterCard, very high quality companies. You could essentially invest in an ETF that tracks the S&P 500. Now, for US investors or those who have access to VO, this is a very strong ETF. In my opinion, if this was available, this is one that I would add. As we can see, the expense ratio is very low, 0.03%. On this channel, one of the lowest expense ratios when comparing it to others, as we have gone through those in detail. Now, for those that are interested, this essentially, in terms of their holdings, tracks the S&P 500. So, for example, if you were to invest $100, 7.16% of that, so $7.16, would have been invested into Microsoft. You then have $6.16 invested into Apple, and so on. So we can see the top 5 holdings are Microsoft, Apple, Nvidia, Amazon, and Facebook. Now, not all of them will be dividend paying, but as we can see, strong companies nonetheless. Now, the one that I personally invest in myself, as I do not have access to this, is VUSA, which is the European equivalent. It also tracks the S&P 500. The expense ratio is slightly higher at 0.07% as opposed to 0.03, but nonetheless a very strong option for portfolios. And when we do take a look at their top holdings, exactly the same as it does track the S&P 500, we have Microsoft, Apple, Nvidia, Amazon, and Facebook. Now, personally, for me, the way I do have my portfolio set up is I do hold a fair portion in ETFs like this one that we have here that tracks the S&P 500, whether that is VUSA or whether or not that is VO, depending on what you have access to. In my opinion, whilst also holding some very high quality stocks like the ones we ran through, it isn't a bad idea to also hold some portion of your portfolio in an ETF. Again, that is different on different investors, so I am interested to hear your thoughts. Whether or not you invest solely in dividend stocks, whether you invest in non-dividend stocks, or you have a portion, like myself, in ETFs as well. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop, and also let me know your thoughts on today's episode. As always, have a great day. See you on the next episode. And one more thing just to point out is that we have released our latest free weekly article. So if you do want to gain access to that, do click on that pinned comment below, sign up, and you get instant access to every single one of our articles on this newsletter. For now, take care and see you later.